conversations.
Yeah, well, I think a lot of people were curious about your underwriting stuff, so we'll uh we'll see.
Awesome.
These things are hit or miss.
Yeah, for sure. Whoa.
Have you guys found a buyer for that property yet?
Which one? Oh, the White Rock Lockwood flip?
Yeah, yeah.
Not yet.
Man, I got so excited when I saw the numbers, but I refuse to do anything on a corner.
I hear you. To each their own.
I know, I know.
I would take it. I like corner lots. I don't know what, I don't understand why people don't like corner lots. Why don't you like corner
Well,
lots?
I'll tell you just from the listing side, they're really freaking hard to sell.
Really?
Really hard to sell. Yeah, you limit your buyers. Anybody who doesn't want road noise, which is a lot of people. Anybody who has young children, which is a lot of people.
Hmm.
Um, but road noise is a big one. I refuse to live by anything that backs up to a road just because I enjoy my yard space so much that I don't want to have to hear.
Right. I can see that. I love them. I love corner lots.
Yeah, if it's in a neighborhood, but that Jupiter Road is really busy.
Yeah,
So they're,
I think I know exactly what house that is because when I'm going down Jupiter, like I went through Google on the Google Maps, they have like tents in their front yard that are covered up. And so they're one of those people that do the huge blowout garage sales like over the weekend. If you'll see when you're driving around and you see these huge like tables set up with all this stuff for sale.
oh, I wonder if they do like the wholesale or something, if they buy stuff in bulk and then do garage sales.
I think it's like stuff that fell off the truck, if you know what I mean.
Oh, yeah, those.
I'm not
Gotcha.
sure. I don't know. That's an assumption on my part.
Also, evicting people sucks.
Yeah.
I've done that too.
Yep. Never fun.
Never fun. Never fun. We'll get going in just a bit. Hey, Maria.
Hey, how are you feeling?
Oh my gosh, I'm a new woman. I'm a new woman, or at least the woman I was.
Well, that's a good thing. That's
What
good. I'm glad
sucks is
you're.
I was supposed to be in Lubbock today, visiting our new division out there, and
Yeah,
I canceled the trip last night because I was like, I just don't know if I could do it. I don't want to get
yeah.
anybody sick. I'm still feeling crappy, and now I feel great. So I wish that I was there, but
But you know,
better safe than sorry.
your mind can play tricks on you. So I recommend that if you feel tired, rest because then it's gonna come back and hit you harder, and then you're really not gonna be able to get up. So take it easy. Just because you're feeling well does not
That's a
mean that you're
fair
a hundred
point.
percent.
That's a very fair point, and I want you to remind me that about 5 o'clock today.
I can do that. I can definitely do that.
I love it. I love it. Thank you. Always the mama bear looking out.
Yeah.
Always.
Okay. I'll turn it down. You're okay.
All right. Well, I think we should go ahead and just introduce our amazing guest today. Josh Dees is an agent. He's not an agent. He's an investor married to an agent, Elisa, one of our very own. But I feel like you are a agent in everything but name by the amount of support you've given to the BK agents. And so we thought today would be a great opportunity to bring you on, Josh, and kind of share some of your insights on the investing space. And so I wanted to just take a minute and let you introduce yourself, kind of share your background, what got you into real estate investing, because like most of us, I'm sure you didn't start your career as an adult thinking this is what I want to do. So what got you here and what are you doing right now?
Sure. And thank you so much for the opportunity and the ability to be here with you guys. Not lost on me at all. Thank you so much. So it started off, it all starts with a Google search, right? So I've worked many W-2 jobs, traded my time for money most of my adult life. And then one day, I remember, I think I was sitting on the bed with Elisa, and I was just took out my phone and I was like, how do you get rich? Like, how do rich people get rich? And the Google results were like Amazon drop shipping, be born wealthy, and then there was like some real estate stuff. So it's like own properties. And the easiest way to get into real estate investing is wholesaling. So I was like, okay, what is wholesaling? And at the time, I was working in the collateral loans and entry-level finance field. I was a pawnbroker at a pawn shop in Pleasant Grove, which is not too good part of Dallas. But so I was already kind of used to the buying low, selling high, and talking to people that were in kind of wonky positions in life anyways. So it was kind of like, hey, yeah, I get the gist, with this. And it was off to the races after that. So it was just kind of a culmination of things. You know that there's this other side to things, but you don't really know how to get there. And it's been a journey. And it's not done yet by any means.
No, as it shouldn't be.
Yeah.
That's
Right.
the great thing about real estate, right? Is
Yep.
there's no limit to the amount of money you can make and what you can learn while doing it. I'm still learning, and now especially in this position as a broker, there's even more things to learn. A lot of it is how not to get sued.
Well, that's actually interesting because we're going to go over that in my presentation today as well from my side of things. So you'll get double knowledge.
All right. So would you say that the majority of your business now, Joshua, is, and do you prefer Joshua or Josh? Because I've said it both ways.
Call me what you want, just don't call me late for dinner.
Okay.
Josh is
So I'm going to go with Josh then. So Josh, would you say the majority of your business now, your income that is wholesaling?
I would say yes, it is a mixture of wholesaling and creative finance deals. But wholesaling is today money that is today. You go to closing and you get a check. A lot of creative finance money is referred to as tomorrow money. So it's mailbox money. It comes in drips, a couple $100 here or there off of different properties. And it might not sound like a lot for just one, but once you get to 5, 10, 20 of these, if you're making $200, $300, $400 a piece cash flow off of each of those, it starts to add up. And then you can get to a point where you essentially replace that W-2 income that you had. And at that point, correct me if I'm wrong, but you're kind of retired, right?
So when you say creative finance deals, I understand what you're talking about, but could you break that down just a little bit for people that are new to that? And sorry for everyone that does understand, but when you're saying you make a couple of hundred here and there each month off of these, are you saying off the notes? And then what do you mean by that?
Yeah, so there's essentially 3 forms. And what I'm talking about is owner financing or seller financing, as it's probably understood by you guys. And there's essentially 3 forms of it. There's free and clear, there's wraparound mortgages, and there's the buzzword incoming subject to. So yes, all of these are properties that we have bought in one way or another, or control in one way or another, and we have put in place a promissory note and a deed of trust. And we are the payee for that deed of trust. So that money that borrower pays goes to us.
And usually, I mean, the margins are typically kind of small on those. Like you said, 100 or 200, sometimes 300 or 400
Right.
on that spread between whatever the mortgage amount is and whatever the new buyer is paying on their mortgage, whether it's the existing PITI is $1,000 and the new one is $1,500. So there's that $500 spread. That 500 goes to you.
Correct. So we're like a used car salesman. We don't hit the lottery every day, but we make a little off the middle. So if I have a note or if I have a mortgage where I like to think of things in terms of money in, money out, just like a rental property. For all intents and purposes, just think about it like you're a landlord and you have a rental house and you can rent this house out for $1,500 a month, but you have a mortgage on it and that mortgage is $1,000 a month. So what you have left over is $500 a month, and we call that cash flow. So that cash flow goes to us. So we make a little off the middle.
So let me take this a step further then. So for people that are like, okay, this sounds interesting. Brittany's talked about creative financing before. I think I understand that part. And they have someone that is interested in doing it, and then they want to be the person that is you, Josh. Do you use a third-party servicing company to manage the payment to the existing mortgage holder, such as Chase Bank, to make that payment and then cut you that $500 check? And a third-party servicing company, guys, is just a company that handles those payouts. They get the check from the end buyer of $1,500. They cut the check to Chase for $1,000, and then they cut a check to Josh for $500. Do you use a third-party servicing company?
Every single time.
And why would you want to use a third-party servicing company?
Number one, it makes things easier because I don't service my own notes. If I was to service my own notes, I would have to learn a bunch of weird math and have this Excel spreadsheet system and keep track of files for a bunch of years, and I would just rather not do that.
Yeah, leverage your time, right?
Right.
Your time
So
is worth a lot of
servicers,
money.
exactly. Servicers are experts at servicing, so leave it to the experts. And the cost isn't, it's fractional. It's like
35 bucks usually,
yeah,
right?
it's like 35. And a lot of times if you're selling a property to somebody, you can get the buyer to take that cost on. So a lot of times it's not even any money out of my pocket, and it makes bookkeeping and record keeping and keeping everything legal and above board extremely easy.
Love it. Which service company do you use typically?
I use Provident. I have used August REI in the past. I've used Sam Home Key, and the other ones don't come to mind, but we've recently switched over to Provident and we love them. And there's no business affiliate. You can use them, you cannot use them. I don't care. They don't pay me to say that. It's just, I like
Yeah,
them.
no, that was a personal question because I've used HomeKey and had a horrible experience.
Absolutely, especially with reps. They're a nightmare.
It was a disaster trying to collect on a foreclosure process.
Yeah,
But
so the guy who owns Provident Loan Servicing, his name is Sohail, and we're actually friends on Facebook. We talk all the time. I can introduce you if you like. He's an awesome guy. I love him. He's good. So
Did Soho used to work at a different company?
I believe so.
Alex, that's exactly what I was thinking about. And that, anyway,
Yes.
let's
I think
table
he
that.
actually, yeah.
Hope that's not bad.
Awkward. Anyway, but you never know. It could totally be a different situation that we're thinking of.
Right. Yeah, for sure.
But we wanted to talk about creative financing today, but a lot of us want to talk about underwriting.
Okay.
So
Well,
go ahead and dive into what you've got for us.
Okay, cool. I have a presentation for you guys. I hope we don't run out of time. Cut me off if we're getting close or whatever. So here we go.
Let's do
Can
it.
you guys see?
Yes.
Can you see me? Can you hear me? Okay, cool. So this is a presentation about creative financing and underwriting deals, strategies to elevate your real estate expertise, widen your scope, get you paid, and keep you out of legal trouble. So who is this guy? My name is Josh Dees, and I have absolutely nothing to sell you. Wink. So I'm an investor in North Texas. I've been an investor since 2018. Elisa Dees is my wife. We've been together for 14 beautiful years. I've done a lot of deals. I stopped counting ages ago, ranging from so simple a caveman could do it to highly complex transactions with seemingly endless moving parts. And I'm sure you guys understand how that feels. So big thank you to Brittany Kozev and BK Real Estate for having us on today. We're going to learn a lot about creative finance and how once you understand it, it can unlock new opportunities for you, your clients, and your business. We're going to try to cover a lot of ground today. If we run out of time and you still have questions, let's connect. I encourage every single one of you to steal my shit. None of this is proprietary info or copyrighted trade secrets. Take screenshots, record, ask questions. This is for you. Call if you hit a wall. That's my cell phone number. Got my email there. You can reach me on Facebook at Joshua Dees, or get in touch with Elisa and she'll point you in the right direction. I'm here to help. We live to serve. Hashtag we not me. We come all up together. So I saw this quote and I thought it was really cool. Reach down and pull someone up, and then reach up and ask someone to pull you up. We're all in various stages of being the puller and the pulled. Nobody's at the top. We're all climbing together.
I love that so much. And I'm just going to stop you there because
Yeah.
I live by that same motto, Josh, and I learned a long time ago that when you are making yourself better and you truly want the people around you to be better, that it elevates you even faster. And so it's like taking an elevator with the speed set to the highest and you shoot straight to the top. So
right. I heard one time somebody say something, if you want something in life, the quickest way to get it is to help somebody else get it.
I love it. I love it. And it also, I feel like so many people wait until they feel like they've mastered something totally before teaching it to others. But I know that for me, and I'm sure you feel the same way, that you don't know every single thing about creative financing, underwriting, and real estate investing. But it's when you put yourself out there and you're willing to share what you do know that it cements it. And then you're just going to end up helping others along the way. So thank you so much. Before you dive in, I just wanted to say that I love that attitude.
No problem. You're very welcome. So what the fuck is even creative financing? Creative financing is flexible, non-traditional financing methods to both buy and sell property or anything else you want to buy and sell. Cars, boats, heavy equipment, machinery, businesses. Matter of fact, the majority of all businesses that are sold with some form of creative financing, usually seller financing. This is non-recourse funding, meaning it's asset-based. There are no bank statements, no social security numbers, credit checks, no pre-qual, no asking the bank for a loan, and it's not based on you or your loan ability. Examples of creative financing are seller and owner financing, buying property subject to existing financing, wraparound mortgages or wraps, basically buying and selling anything on payments or terms. The benefits of it are you solve tough problems for your seller, you create win-win deals, you expand your buyer pool, you win bidding wars, you can buy and sell in ways that most people are still unaware of, and you can double or even triple your equity in some cases. Some more benefits are no banks. There's no strict lender requirements or credit checks, faster closing, more deals, more opportunities, flexible terms. A lot of them are low or even no money down. You can mix and match and leverage this with that. You can do subject to with seller financing and other strategies like BRRRRs, wraps. The possibilities are endless. It's like Sonic with all their drink combinations. So it's a win-win for buyers and sellers. Sellers get to move their property more quickly. Buyers get financing that they probably wouldn't have qualified for otherwise. And you can maximize your cash flow on the deals that you are doing. You can control more properties, right? Because that's what we're doing. We're playing this big game of Monopoly in real life without tying up capital. Not just for houses. So this is a 1967 Shelby GT 500. Most of us know this as Eleanor from Gone in 60 Seconds. I met this guy at a gas station and I asked him if it would ever be something that he sold for the right price, of course. He said, yeah, for 120,000. So I whipped out my handy dandy financial calculator and showed him what that would look like. So at 120,000, let's assume 10% down, that's cash in his pocket. 4% interest brings me to about 500 and some change a month. Not bad. What do I get? What does he get? I get a bitchin' ride, and he gets over $75,000 in pure interest. And he gets to sell his car for over $185,000 with no capital gains tax. When you sell things on installment sales, you bypass capital gains tax because the sale really isn't complete until it's reached maturity. So I'd like to introduce my number one most used tool in my arsenal, and it is my 10B2 financial calculator. This is a paid version in the App Store. Sorry if I sound a little out of breath. I get a little excited, so just bear with me. I chose the 10B2. I have my reasons. There are tons of free options out there. So find one, use it, download it, and just practice, running numbers and all that stuff. You want to get to the point to where it's just you and your calculator, just calculating out what deals look like. And so on this calculator, what makes it different besides all the Greek literally on here is these 5 buttons up top. This button that says N stands for number of payments. This one, I/R, is interest per year. PV stands for principal value or present value, and this is going to be the amount of your note. PMT stands for payment, and FV stands for final value. For all intents and purposes, that's always going to be 0 starting out, so we don't even have to solve for that. We just need to make sure that it's 0. And so that just leaves 4 other ones that we have to solve for. Wacky thing about how this calculator works is that when you change one thing, you have to change another in order for that change to be solidified. And so we'll take time, we'll go over and learn, maybe deep dive another day because it's a whole thing, but you'll understand. So what about terms in creative finance? What do terms mean? So there's 6 kind of vanilla terms that are usually used in creative finance, and they are purchase price, obviously, the down payment, the principal value or the note, how much total is being financed, the interest rate, the term, which is how long or how many payments, and of course the payment. How much is the payment? What terms could mean is literally anything else that helps a deal get done. For example, buyer agrees to pay for dinner at Ponchos. I've literally seen this on a contract before, or Red Lobster. Seller to include the hot rod in the driveway, or the antique firearms above the fireplace in the sale. I've seen that before too. I've seen terms like 0% interest, 0% down, 40-year term. So talk about low payments. I've seen terms like if the buyer prepays by a certain date, buyer receives certain amount discount off the total amount. So if you have a note for $100,000 and it matures at some time in the future, let's say 10 years from now, if you prepay or you pay off that note before then, like let's say you're wholesaling deals on the side and you're stacking up your money and you can just pay off that note, you can write it in the contract that you receive a discount of whatever y'all agree on if that happens. I've also seen all payments interest only for the first 2 years. Thereafter, the payment jumps to such and such per month. And think about this as kind of like a hard money loan, but without a hard money lender. So I've also seen things like substitution of collateral, where you have a mortgage on a house and you take that house and replace it with another house. It's like an infinite mortgage, basically. You also have something called subordination agreements, where your lender makes their first position lien a second or a third, and you can get another lender in front of them. It's all about the art of the deal and what we can agree on to get a deal done. At this point, I'd like to introduce what's called the hairy arm principle. It comes from an experiment where a photographer was tired of his client always changing orders and delaying production. So one day he accidentally included his hairy arm to intrude into the picture area. The client, offended by the hairy arm, demanded its removal, but approved the photo shoot as a whole. So the conversation went like this. Hey, the pictures look great, but there's this big, ugly, hairy arm there. Oh, hairy arm, I didn't notice that. Well, get the arm out of there. You can't have a hairy arm in there. What are you doing? Okay, but when I remove the arm, can we go into production? Yeah, it's fine. Just get the arm out of there. So it's used to include something that you know the other party will reject, which shifts the focus away from the main terms you want accepted. So
I love that. What a cool negotiation tactic, right?
right,
It's a psychology thing.
correct. So example, I'll take the property only if the seller covers all closing costs and repaves the driveway, knowing that the driveway will likely be rejected, but it shifts the focus away from the closing costs. Does it work every single time? No, it's just a cool little ninja trick that I've learned along the way. So Jim Schlechter is an author. He wrote a book called Great CEOs Are Lazy, and he's quoted it saying, when you're buying things, you could always do your price, my terms. The inverse is also true, like for wholesaling, where it's my price and your terms. But essentially, the main point I want to drive here is that price doesn't have to be an objection for you, because you don't have to buy at a discount. So this is how I buy houses at 105% of ARV with no discounts necessary. If your client or your seller or the other person on the other side of the table is dead set on their price, not a problem. As long as they're open and willing to at least have a conversation regarding terms and how we can work that out. If they don't need cash at closing, it's possible, but it's preferred. It's not preferred, right? We don't prefer to have to pay out a bunch of capital at closing. If they don't want cash at closing or they don't need cash at closing, that's great. That's an added bonus. If it's a second home, if it's a vacant second home, if it's a vacant second home and the owner's out of state, that's an added bonus because they don't want to have to drive back and forth and keep messing with it. So if they like the idea of passive income, what we call mailbox money, that's an added bonus, right? If they like passive income and they don't want to be a landlord, that's even better. Nobody wants to deal with tenants, toilets, and trash. So what does it look like? We'll take this one, for example. This is probably still active today. This is a property in Mesquite, and it's listed for $295. It's down from $307, probably by design, but that's okay. So a typical cash offer for this property is going to be somewhere between $165 to $195. If you can tell, it's not updated, still has that rockin' 80s, 90s kitchen, and the bathrooms have wallpaper. So, but these people don't necessarily want to take $100,000 haircut just because the bathroom has wallpaper. So wholesalers, out of luck. If they're willing to talk about terms, here's what we do. Mr. Seller, you want $295? Great, no problem. I love the deal and I can't wait to buy it. So here's what we're going to do. 10% down, which is $29,500 cash to you immediately or at closing. And then we'll have a note for the remaining $265,500, and we're going to negotiate an interest rate on that. The interest rate should be equal or less than average prime offer rate, or whatever prime is this week. I believe it's still 6 3/4-ish, but we always want to start low and negotiate up, right? I'd love to get 0% interest. That'd be great, or even 1 or 2%. So let's say that we settled on 5% and 30-year term. So we amortize the payments over a 30-year term to keep them low, right? 30 years, the max we can do. So let's go ahead and amortize it for that, meaning let's run numbers on 30 years. If it gets paid off before then, great, but we don't want to pay more just because. So what it looks like, 265.5 at 5% over 30 years comes out to $1,425.26. And oh, looky here, the rent rate is $1,977. So if you wanted to mix and match, buy this with owner financing and rent it out, you would be well capitalized. So looks like there's probably $400 or $500 cash flow there. Would you do this deal? Yes, no, yes, no, yes, yes, yes. Cool. How long did that take? Not too long. So this is a form of underwriting. This is just kind of quickly running the numbers and saying, do I do this deal? Do I not do this deal?
And I think sometimes too, Josh, let me
Yeah.
pause you there because you went really fast and I appreciate it and I loved it. But one thing that people don't think about that want to get into creative financing is, do they want to hold that note forever? And if they do, then, you can, if they have the interest rate at 4% for the original and they jack it up to 7 for the owner finance, that's fine if they want to hold it forever. If they don't want to hold it forever, though, this is one thing that I've run into, is they say, a note is an asset, guys, and you can sell that note just like you can sell a car or you can sell a house. But not everyone wants to buy a note with a small spread of from 5 to 7. Oftentimes people want a note closer to 10% if that's the original price. And so definitely think about that if you are wanting to get into this, because we ran into this issue on a house in Odessa that we had a note on. We were trying to sell it and I couldn't find a buyer because we didn't have a big enough spread on the interest rate. Have you ever had a situation like that, Josh?
That is very true. And yes, I have. So note buyers are going to want what's called a yield, which means they're going to buy this note at that payment for that term, at that principal. This right here is the only thing that they have a say in. So if they want, let's say, an 18% yield, I will go to my calculator and I'll replace this interest rate with 18% and I'll hit the PV, and that'll give me essentially my note sale price for them. But yes, I have been there. So purchase price $295, typical cash offer $165, $195. So when we go through the numbers like this, we want to think in terms of money in, money out. At this point, we have the $1,425 monthly payment. We've got $265.5 that we are borrowing at 5% interest for 30 years, and we're paying it until it hits 0. There's no balloon or anything. So total principal is that. These people are going to make almost $250,000 off of pure interest. And the cool thing is that if the loan goes to maturity, they're going to make $500,000 off this house. 2 of those and you're a millionaire. So what does this mean, right? What it means is that if we get 1977 and we're paying $1,425, we're looking at about a little over, almost $600 a month cash flow. For the life of the loan, that's almost $200,000. So do you do this deal? I would do it every day. So moving on to seller financing. This is seller financing tree here. There's 3 main types of seller financing. You'll also hear it referred to as owner financing. They are the same thing. There's no difference. Seller financing is a realtor term. Owner financing is an investor term. Or seller financing is an acquisition strategy. Owner financing is a dispo strategy. But this is the most popular form of creative financing. And it's just where the seller or the homeowner takes on the role of the lender or the bank. We've got free and clear, where there's no underlying debt and the seller is selling on payments. We've got wraparounds, where there is an existing mortgage and the seller is selling on payments that are higher than their existing payments to create a spread, to create cash flow. And then we have sub 2, which is essentially taking over payments. And the cool thing is that all 3 of these can be done with a TREC 1 to 4 and some addenda if necessary. So seller financing. Here we have Mr. Seller, homeowner, who owns this home via warranty deed. And when he sells this home, hooray, we found some buyers. They're going to give him a promissory note and a deed of trust or a mortgage. And he's going to give them the deed to the house. They're going to pay him a down payment and they're also going to pay him monthly payments every single month for the life of the loan. This is seller financing. The sellers own the property at closing. This is not a land contract or a contract for deed. So, deal breakdown. Let's assume that we have a house for sale. Here's the house. Sales price is $100,000. The interest rate is 9.9 and the loan term is 30 years. So what's our payment? Well, buyers, seller finance buyers, want reasonable payments. Typically with owner finance buyers, these folks live in a payment world. So the payment typically controls the mindset and the conversation. Our monthly payment is made up of 4 parts: PITI, principal, interest, taxes, and insurance, maybe HOA, maybe some other stuff like solar if it exists, but that would be kind of sub 2. So we're going to be comparing our payment, everything included, and we're going to be comparing it against rent comps, or what the rents are in the area. That's our main pitch, is why would you rent when you could own for the same price? So what's the rent rate? Is the main question that you should ask when underwriting a deal. Let's assume that we sold this house for $100,000, 10% down. Could be more, shouldn't be less. If you take less than 10% down, like you're trying to sell this house owner financed and you're talking to buyers and you're fielding offers and somebody's like, man, I really want this house, but I don't have 10% down. I have 5%. Can you do that? As difficult as it can be to say no to people and break people's hearts, what you want to make sure that you're doing is you're not hurting yourself in the long run, because if you take less than 10% on that note, 10% down, you might not be able to sell it, because that's what note buyers, that's what we do, is we make sure, first thing that we're going to do when you try to sell us a note is we're going to ask you for the collateral file. We're going to ask you for that background check, the credit report, all that stuff, and we're going to need to know how much they paid down. And if it wasn't 10%, that's a ding for you. So we're just going to enter it in. Number of payments is 360, because as you can tell right here, it says payments per year 12. That's automatically programmed into the calculator. So 30 years times 12 payments a year is 360. Anytime you see 360 payments, you know it's a 30-year loan. Interest, excuse me, interest rate is 9.9, and the amount that we're loaning is $90,000. Why is it $90,000? Because the other $10,000 we already have cash. That's the down payment, and the final value is 0. So our payment comes out to $783.17 per month. And this is what it looks like, and why I collect these like Pokemon cards, or Pogs for the older people. I don't know if you guys remember Pogs, but we are going to make $191,945 off of pure interest. We're going to make $90,000 off the principal, for a grand total of $281,941. We just made 3 times as much off of this $100,000 property. You collect 4 of those, you're a millionaire. Next, I want to hit on wraparound mortgages. This is a wraparound mortgage. Exact same mechanics as seller financing. Sometimes referred to as an all-inclusive trust deed, or an all-inclusive deed of trust. The original mortgage right here stays in place. Does not get paid off at closing. The original mortgage becomes the underlying mortgage, and this other mortgage, our wrap mortgage, wraps around it. Hashtag wrap donut. So let's assume that we sold the property for $295 with a $30,000 down payment, which is essentially 10%, a little bit more. It's like 10 point something, but that's good. When you have a down payment and people are assuming it's 10% down, people will be like, well, I got 20. Will you do that? And you're like, heck yeah, we can do that, because that's more cash in your pocket at closing. Only thing you want to be aware of is you want to make sure that your note is higher than the underlying. All of this seems like common sense stuff, and it goes without saying, but sometimes when we're down in the weeds and we're running numbers and doing deals, it's the simple things that we forget, and it's the simple things that'll bite you. So we want to think about it in terms of money in, money out, just like a rental. We want to make sure all our numbers on our wrap loan are higher than our underlying loan. Higher principal, higher interest, higher longer term, and higher monthly payment. Cash flow is the name of the game when it comes to wraparound mortgage. We are not talking about today money. We're talking about mailbox money. Set it and forget it. All the work that you'll do on a wraparound mortgage is done up front. You're vetting your buyer, you're underwriting them, you're checking them, because with stuff like this, yes, the house is an asset, but the borrower is also an asset, because without the borrower, there's no deal. You can't sell it. So we're thinking in terms of money in, money out. And both payments shown here are actually P&I. We're just matching P&I versus P&I, but all payments will be made up of 4 parts: principal, interest, taxes, insurance. Your taxes and your insurance are actually passed through because your borrower is going to pay those. But you want to run numbers including them just to make sure, and I'll tell you why. It's best to run numbers on worst case scenario, make sure the math is mathing. So with this deal, the potential cash flow of $1,425 money in and paying our mortgage of $719 per month, we're left with $700 and some change per month potential cash flow. Over the life of the loan, that's $250,000. So would you, money in, money out, blah, blah, blah. Would you buy this deal? Would you do this deal? $250,000 for a little bit of work up front? Heck yeah, I'd do this deal. So typical deal killers when it comes to wraps, if the wrap amount is lower than the underlying, like if this was $165, obviously that'd be a no-go. If the wrap PITI payment is more than the rent rate, so this would not fly in a $1,000 rent rate area or a $900 rent rate area. It might not even fly in a $1,200 rent rate area. So it's a case-by-case basis, but we really want to try to match those up. And we need to remember that it's not just this versus rent rate, it's PITI versus rent rate. And we'll go over that in just a second. If there's no insurance on this, that is a no-go. You need to insure your wraps. It's the most important part of a wraparound mortgage is the insurance. If the underlying loan, if the underlying mortgage is a hard money loan or a short-term loan, that's a no-go. If the underlying mortgage has a balloon, that's a no-go. If the underlying mortgage is with a very small lender, like Bob and Tom's owner finance shop down the street, like, no, we're not doing that, because those people are more likely to call the note due. If the underlying mortgage has private mortgage insurance or a mortgage insurance premium, that can really mess with your numbers. So you want to make sure that you calculate that, but be aware, PMI does not transfer. It is not passed through. You cannot put that on your borrower. So for taxes, sometimes the folks that we buy the houses from have exemptions on taxes. Maybe they're elderly, maybe they're veterans, whatever the case may be. Dallas County CAD does this, some CADs don't, but I can see here the tax rate per $100, and I can also see the current valuations. I also know that our new valuation is going to be $295, and we don't want that borrower to get slammed with a new tax appraisal that's way more than what they thought and messing up the numbers. So what we're going to do is we're going to find the true taxes. We're going to take our new valuation, we're going to divide it by 100 because this is tax rate per 100, and we're going to find out how much we owe Mesquite, Mesquite ISD, Dallas County, Dallas College, Parkland, so on and so forth. After calculating all those, we found our true taxes to be almost $7,000, even though the total estimated taxes are lower than $3,000. This is because this is an elderly person and they have exemptions. So that's going to add $570 to our monthly payment. But it's also going to add it to theirs. So the difference between the two is still $700. We're good. Insurance, the most important part of a wrap. The borrower that you sell the house to will get their own insurance policy. They have to. Otherwise, I'm not selling them the house. And it's going to be escrowed because I'm not chasing it down. You're going to want to make sure that your insurance policy is equal to or less than your borrower's policy. Shoot for less just in case. When we're cash flowing, we want to cash flow off of every single element and parameter of this deal, just to make sure that we're in the clear. We don't run into things like negative amortization and stuff like that because it's just a hot, sticky mess. Nobody likes to deal with it. So, builder's risk policy. This is used for flippers, and it's roughly $100 a month, and they offer a 6-month policy. I've used Riskwell in the past. James Jenkins is a a pretty cool guy. He's awesome at what he does. They don't pay me. I don't get paid for saying this. Use them, don't use them, I don't give a shit. But I've used them before, and it was cool because it got my deal done without massive amounts of capital, me having to spend to get the deal done. So
one thing I heard, and correct me if I'm wrong, is that changing the insurance policy is one of the big triggers for the due on sell clause.
you're not changing it. You're not changing anything. You're adding a policy.
Yeah, so you just keep it in place.
Yep. Yeah, so these insurance rates are crazy these days. Necessity is a mother of invention. Sometimes we have to get creative. So you're going to need more additionally insureds than you think you will need. When you buy an insurance policy for your wrap, you need to add your company, the seller, and their bank all as additionally insured on your policy. And then the borrower is going to get yet another policy. So this thing is not only insured, it's bubble wrapped, it's got pillows, it's like a bubble boy, right? Nothing is going to happen to this house. The main reason why notes get called due is because they're not insured, or they're not insured properly. And here's what that looks like. You buy a house, you don't insure it, time goes on, you file the deed, and the bank notices, they run a title search, and they see that the property's been sold. They send you a letter, a nasty gram, in the mail that says, hey, guess what? You're in default to one of the terms of your mortgage, and we're going to call this note due. You have 30 days to sell this property. That's what having a note called due is. That's the nightmare that everybody talks about. And it is a nightmare because at that point, you're not the one who's living in the house. You already have this house sold to someone else. So what are you going to do? Like kick them out and sell the house? No, of course not. There's always something that can be done. If you ever find yourself in this situation, I suggest you contact an attorney and you have them call the bank and figure something out, because it's not an end all be all, right? There's always things that you can do. If need be, you can try to find some funding that can replace that mortgage, pay them off. You can dip into your private money people to see if you can borrow some money, or you could find out what the real problem is and you can fix it. And then sometimes that bank will rescind that notice, because at the end of the day, it's not like the bank wants to take your house. They don't. The bank doesn't want to own properties. That's not good for a bank, because then they just have this vacant house sitting there and the bank is on title. And then if somebody were to happen to go or break in or be walking across that property and injure themselves or something, or if the house burned down or a water pipe froze or something, that would end up putting the bank in a bad position where they're going to have to fork out money. And the bank doesn't like to pay money. The banks like to receive money. So it's not that the bank is like, oh, we're going to take your house. That's not it. They just, what you have is anywhere from $250,000 to $750,000 of an asset. So think 2025 Lamborghini Huracan or Aventador that you just got the keys to, a lot of times for free. And now think about if that were your Lamborghini Aventador and you told Bobby that he could drive it. And then you're walking down the street and you see Jake driving it. And you know that Jake doesn't have insurance on his own car, so he's probably not that good of a driver. And you're going to be like, what the hell, Jake? What the hell, Bobby? That's usually what happens. It's because of the asset and the fact that it's not insured. Lack of insurance and lack of properly insuring properties is the number one reason that loans get called due. Period. Any questions about that? Sweet. Subject to a brief history. Subject to financing is nothing new and has been around for over a century, probably when this photo was taken. But it really took off in the 1980s when interest rates soared past 15%. Buyers were struggling to qualify for new loans, so creative investors started taking over existing low interest mortgages instead of getting new financing. That sounds familiar. Fast forward to today, And we're seeing a resurgence of subject to deals with rising interest rates again and making financing expensive. So investors and homeowners are using this strategy to keep low rate loans in place, making deals work that wouldn't otherwise. And now when you go to places like YouTube and type in subject to, you see this bozo with his happy peace fingers all over the place. As agents and investors, you'll come across sellers who can't sell traditionally. Maybe they've got no equity. Maybe they got a mortgage payment they can't afford, or the house needs work or something. Instead of letting these deals die, call me. Instead of letting these deals die, understanding sub 2 gives you an extra tool that helps them while still getting paid, while still capitalizing on that deal, monetizing, creating commerce, thriving your business and growing it. So at its core, subject to is as simple as this. The buyer takes over the payments of the loan. Period. This is not a formal assumption. If I'm buying the property sub 2, I'm not going to the bank. I'm not walking in there. We're not doing a credit check. You're not going to run my shit because I'm a flight risk for the banks. I've got multiple properties, multiple mortgages. I've got more than 10 mortgages. I've done more than 10 houses. So I don't qualify for a loan from Fannie and Freddie because you can only have 10. So if I were to go into a bank and try to formally assume your mortgage, number one, if you bought your house in COVID and you got a 2% mortgage, they're not going to want to give that to me because they're like, well, it's not 2% anymore, buddy. Now it's 7. I don't want 7. I want 2. So selfishly enough, I'm not going to formally assume that mortgage. At its worst, what subject to is technically is an unqualified assumption of a loan. But that's not what we're going to say. When you're talking to a seller and you're pitching sub 2, all you're going to say is, I'm going to make your payments on your behalf moving forward. So here's what that looks like. We have Mr. Joe Borrower, who owns this property via a deed, and he's got money. And he gave Chase Bank a mortgage and deed of trust for this property, and he pays that mortgage to Chase Bank. This is what's known as normal. If that stops and goes away, Joe Borrower may be in default and bad news. So along comes Lisa Investor with her pink agreement. She and Joe Borrower come to an agreement to buy the property subject to the existing financing, and Miss Lisa is going to make Joe's payments on Joe's behalf moving forward. Joe gives Lisa the deed to the property, and Lisa takes her money and she makes the payments to the bank. So as you can tell, Lisa owns the property, Joe owns the deed. This is subject to. Any questions on this? Fantastic. So a deed versus a deed of trust. What's a deed? What's a deed of trust? A deed conveys legal title.
I'm excited you're going over this.
A general warranty deed is the best of the best. When you get a deed, you want it to be a general warranty deed. A lot of times you'll hear people say with seller financing that the deed is held in a trust by a trustee and blah, 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 blah. You don't get the deed at closing. Yes, you do. You get what's called a warranty deed with vendor's lien. So you have a deed. Can you sell the house? Yep, but that lien needs to be paid off first. It's okay. On the other end of the spectrum, a quick claim deed is the worst of the worst. It is BTN, baby. Better than nothing, but good luck because it's not accepted or recognized in most title companies and is completely fucking worthless for conveying anything because nobody recognizes it as anything. Essentially what a quick claim deed is somebody says, I don't know shit, I don't know this house, I don't know anything about it, but sure, I'll sign this. That's what a quick claim deed is.
What do you think? Why do you think people keep using those?
Because they are very easy to
And they want something,
with.
right?
Yeah.
They want something.
Right. So if you dial a wrong number or you get a hold of a relative, or if you're a couple degrees away from the person that you need to be talking to, the person who can affy under oath and swear and promise that this property is free and clear of debts and liens and any encumbrances throughout its entire history since they've owned it, and they're willing to sign and notarize and under penalty of perjury swear to that fact, that is a general warranty deed. If they're not willing to do that, if they're like, I'll sign a quitclaim deed, run far, far away, because the person you're talking to might not even be the owner. And the reality of the situation is that deed fraud exists, and especially in real estate, fraud exists. We've all seen the footers on all of our title companies, emails and all the big red letters and stuff. We know. So our part in doing that is partly education. We want to educate ourselves. This is not a fully comprehensible list of all the conveyance instruments. There's a shit ton more than that. There's ladybird deeds, transfer on death deed, all sorts of stuff. But I wanted to cover the two biggest ones. Is that whenever you do this, you want to get a warranty deed, not a quitclaim deed. So, as well, a deed of trust is not a deed. It doesn't transfer or convey ownership. What a deed of trust does is secures that money to that asset. It's a mortgage, essentially. It's a security instrument. It's basically 20 pages of foreclosure instructions. Like, it'll list off the borrower, the lender, how much they borrowed, and then it's 20 pages of foreclosure instructions. So a deed of trust is not a conveyance instrument, and a deed is not a security instrument. What we have here are security instruments. We have a deed of trust and we have a mortgage. They're both the same exact thing. They both do the same exact thing. So what's with the name change? Well, the main difference is the number of parties. A deed of trust has 3 parties: borrower, lender, and trustee, aka attorney. A mortgage has 2 parties, a borrower and a lender. So the secondary difference is the foreclosure process, which is something you're going to want to become familiar with if you're ever a lender. So there's 2 types of foreclosure: judicial and non-judicial. Judicial, think Florida, heaven's waiting room. The lender has to file a lawsuit in court. First, they have to hire an attorney because there's not one built into the document. They have to hire an attorney, they have to obtain a judgment, they have to foreclose on a property. Think Florida. The borrower is served with lawsuit papers, usually by sheriff, process server, and then it becomes what's called a lis pendens, which is Latin for suit pending or legal action pending. Then they go to court, the borrower can defend and postpone and and the process can take several months or years. No thank you. Non-judicial foreclosure, like we got in Texas, baby. The lender forecloses on the property without going to court. It's very simple, quick and dirty. The lender sends the borrower a notice of default, which is just a piece of paper that says, hey, buddy, you borrowed $300,000 and you stopped paying me, so now I need it, which is actually the same as calling the note due. It's the same exact thing. The lender then appoints a trustee or an attorney to foreclose on the property. The attorney initiates the foreclosure sale without a lawsuit, and the process is faster than judicial. So if you're going to buy notes or you're going to do creative financing, just make sure that you stay the hell away from these blue states unless that's what you like and what you want to do and you're prepared. But hey, I told you. So deed of trust is non-judicial. Does that mean Texas is a non-judicial state? Does that mean there's no mortgages in Texas? No. A HELOC is a mortgage. If you go in county records, you'll see all sorts of mortgages all the time. But the same rules apply. Non-judicial states foreclose non-judicially unless the document has specific instructions. The document controls. But for all intents and purposes, most deeds of trust in Texas are non-judicial. So the foreclosure process looks like this. You don't pay your mortgage for 90 days. You become what's called 90-day late. The bank files what's called an appointment of removal and substitute trustee. What that means is they're hiring a new attorney to foreclose on you. That's what it means. They file that in public records. That is a form of notice. They've put you on notice. 30 days later, once you hit that 120-day mark, you get a notice of default with intent to accelerate, which is just a nasty gram. And it just says, hey, as you very well may know, you are behind on payments and we intend to foreclose on you. And then 21 days, aka 3 weeks before the auction, you get what's called a notice of trustee sale, which just says we're going to sell it. Here's how we're going to do it. Here's when we're going to do it. Are you about to lose your house? And that's essentially what it says. So in Texas, we have one auction per month. It is the first Tuesday of every month, also known as Texas Tuesday. The trustee is the one that forecloses. Why does any of this matter? Okay, so 2008, never heard of it. Cool. Back in 08, the powers that be decided it was a great idea to hand out mortgages to people who couldn't actually afford them. Banks were basically throwing loans around like candy on Halloween, like stated income loans. Meanwhile, Wall Street bundled these risky mortgages into magic investments called mortgage-backed securities. Think pinatas stuffed with loans of all shapes and sizes. And they tried to short the housing market like it was a stock. So fast forward, shocker, people stopped paying their mortgages. The whole house of cards collapsed. Major banks went belly up. Global economy tanked, and we got the 2008 financial crisis. Enter the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, aka Dodd-Frank, and the CFPB, the Consumer Financial Protection Bureau. Washington's way of making sure this mess never happens again. Think of the CFPB as the love child of reckless Wall Street and government bailouts, born of the 2008 mess to make sure banks couldn't pull the same stunt again, at least not as blatantly. So the Dodd-Frank is basically rules to keep real estate financing fair and transparent and keep all of us out of jail. The CFPB enforces these rules, along with two key laws. You've probably heard of this: Truth in Lending Act and RESPA. Truth in Lending requires clear disclosure of loan terms, interest rates, and costs so that buyers aren't misled. And RESPA prevents hidden fees and ensures transparency in real estate transactions. Truth in Lending, if you do 5 or more deals a year, you must provide loan disclosures. And don't charge people usury. Stay away from 18%. You can get right up to it, but what you don't want to do is create what's called a hope loan. You also want to make sure the people that you are loaning money to, well, not loaning money to, but putting in these houses as borrowers, can actually afford to repay you, so that we're not just bringing people in, foreclosing on them, and destroying people's lives left and right, because that's predatory. No balloon payments. So what's the, where do we fit in? Well, if you do a deal a year, you're mostly exempt. If you do multiple deals, you got to follow lending laws to stay compliant. It's all a bunch of hodgepodge, really hard to decipher stuff. The good news is use an RMLO on every single deal, and you don't have to worry about this. Use them to underwrite. Use them for all of your underwriting. Use an RMLO. I use Texas Pride Lending. I like them, not affiliated. Use them, don't use them, don't care. RESPA applies to federally related loans. Not so much private owner finance deals, but it does still apply because it is a law.
It hit the hour mark, just letting you know.
Okay, yeah, no problem. We are almost done. 5 or more a year, no kickbacks, and if you collect taxes and insurance, RESPA is going to regulate. So again, use a servicer. You don't have to worry about it. I use Provident, not affiliated. Use it, don't care. Ground rules: no interest only periods, no negative amortization, no balloon payments, and loan terms must be 30 years. DTI's got to be under 40% for everything, not just the mortgage. You want to create what's called a qualified mortgage. So check your upfront fees and points. Extending them may qualify it. Again, use an RMLO to underwrite your deals. I don't know how to underwrite like an RMLO knows how to underwrite. I know how to underwrite for me and if a deal is worth doing. But in terms of like mortgage underwriting, federal mortgage underwriting to the law, no, I'm not licensed. I'm not a loan officer. I have no idea. So use an RMLO for every single deal and try as hard as you can to make every single mortgage a qualified mortgage. What's qualified mortgage? No interest only, no negative amortization, no balloon payments, 30-year max. Creating a qualified mortgage will also help you later on down the road when and if you want to sell that note. Double E Investment Properties, LLC, is a note buyer. If you have a note that you like to sell or you know somebody that wants to sell notes, call me. I'd love to price it out for you. Good news for investors: everything I just went over does not apply to commercial loans. So if the consumer is the lender and the buyer's an LLC, that's a commercial loan. Investors can place themselves in that position all they want. It's still non-recourse funding, and consumer laws don't necessarily apply because my LLC doesn't need consumer protection. Consumer is going to be Chase, Wells Fargo, Rocket Mortgage. Commercial loans are hard money loans from Easy Street. So on the buy side, if your LLC is the one buying, you're good. Whatever you want, whatever terms, doesn't matter. On the sell side, if you're selling to a person, a normie, a non-business, this is when CFPB kicks in. This is when you're going to be under the microscope. Also, I wanted to hit on these. These are triggering terms from the CFPB. In case you didn't know, anytime that you've listened to the radio and they've talked about anything money, like, hey, come into your local Lexus dealer and get a lease. And then at the end of the commercial, they're like, must be 18 years or older. That's because everything they said in that commercial is a triggering term. And if they didn't have that disclaimer, they could go to prison or court. Sorry, prison's a little hard. So what are triggering terms? Any talk of down payment, any talk about number of payments, any talk about the payment amount, any finance amount charge, any interest, basically anything about the deal. If you are the one marketing the property, you are the one that has to follow the law. So what do I do in this scenario? I say, go talk to the RMLO, because I don't even know. I don't know how much you qualify for. I don't know how much to charge. I don't know what's legal, what's not, but they do because they're licensed. They're experts. Let them earn their money. Let them use their license. It's what they do. They love it. They love talking about down payments and payment amounts and interest and all that stuff. Let them do it. It's their job. Keep yourself out of it. Thinking outside the bank, bringing Wall Street to Main Street. So basically, this is a way that you can, as investors, need to get creative with funding to make deals happen. These are ways that we can do that. Seller financing, subject to hard money. Wait a second. Seller financing is private money. So private money isn't just about borrowing from investors. It's actually one of the purest forms of private money would be seller financing, because the seller's acting as the bank. So in seller financing, seller's a lender, and you make payments to them directly. This is a form of private money, because how would the conversation be different with a private money person? It really wouldn't, right? So seller finance is private money. You can skip the bank, no underwriting, no credit checks, no waiting for approval. Sellers can get higher price. Buyers can benefit by avoiding today's high interest rates, or even hard money high interest rates, 14% interest. No. So it works especially well with free and clear sellers who don't need all their cash up front. This is the best thing since sliced bread. Let's say a seller wants 300, but cash buyers are offering 200. Instead of discounting, the seller finances the deal at 6% over 10 years. The buyer gets easy approval and better terms than hard money. The seller earns more over time than they would in an all cash sale. By positioning seller financing as private money, just think about how many more deals you can unlock. Think about how many more sellers you can help. Think about all the cash flow you're about to create without relying on banks. So what's the perfect deal? The perfect deal, so not about the house. And I can't stress this enough. If it were about the house, and it'd be like the house needs repairs, but it's not like condemned or tear down status. But essentially, remember, the house is an asset. The note is an asset. The borrower is also an asset. The seller in acquisitions is an asset. So I'm looking for sellers that are behind on payments, sellers that just want to get out from under the house, sellers that are willing to sell for what they owe and have a conversation with me, right? Not slippery, not squirrely. I don't have to triple, double tap them to get in touch with them. We don't do bidding wars. I've never, ever, ever been the highest offer. It's not my style. And then I got some case studies if you guys want to see. So this is the last part.
Josh,
Okay, cool.
You're killing it here.
Okay, keep going or no?
Up to you guys.
I'm going to keep talking. I'm going to ramble. So,
all right, go.
This is Brandy. well, this isn't Brandy, this is Meadowbrook, but Meadowbrook came to us because of Brandy. So a traditional sale wasn't possible, but a creative solution turned this into a win-win. The listing agent referred me to Brandy, who recently became a widow. Her husband died suddenly, and she had to move back to California. She couldn't sell her house because there wasn't enough equity, and she was falling behind on payments. They were about to foreclose. Every other buyer walked away. They're like, no, this doesn't work. But instead, I structured a subject to deal. So I took over her existing mortgage. I wrapped it with another mortgage. I actually worked with my buddy's company to do this. So at the end of the day, I assigned it to them for 10K, but I still am a silent kind of partner in the deal. We wrapped it with another mortgage and I sold it. We sold it owner finance to a buyer, couldn't get traditional financing. So the seller avoided foreclosure. I created a profitable deal and the buyer got home ownership that they couldn't have qualified for otherwise. I signed up for 10K and $325 a month for 10 years, which equals out to 49,000 gross profit. This deal took like a month. This is Larkin. Larkin came to us by Tina, who is an out-of-state absentee owner that wanted to sell and walk away with 40,000 over the amount of her mortgage, which was about 111,000. So roughly 150. I started off with a direct mail list. I wasn't getting any calls in, so I decided to call out. I took the list and I just started hammering it. Tina lived in California. She had a property management that just finished rehabbing it, and she was willing to do sub 2, but she wanted 40K to walk away. I made money 3 different ways on this deal. So she wanted 40K. I sold it for 50K down. I made 10K profit on the down payment. Monthly payments, the buyer prepaid 6 of them, so we made another $6,700. And the delta or difference between the underlying lien and the wrap lien from a note sale, which is another like $20,000. I sold this on FSBO for sale, or Zillow for sale by owner, as owner financed. I took over her existing mortgage. I wrapped it with another mortgage to create a spread. I sold it owner finance to a buyer who couldn't get a bank loan. They also prepaid 6 months of payments, and I sold the note shortly after closing for par, which is face value. And the reason I was able to do that was because I got 10% down, or more than 10% down, and the buyer prepaid. All the terms were great. It was a 9.9% interest, so the bank was happy to buy it for face value, meaning there was a note for 130, they bought it for 130, and then they paid off the underlying loan as well. So, or with that note, something. I don't know what they did, but all I know is that I didn't have to take a discount on the note. So I created a profitable deal. The seller got her cash, the buyer got home ownership that they wouldn't have qualified for otherwise. This property was my neighbor. His name is Charlie. Charlie was in pre-foreclosure. He just got divorced and he had a bunch of people living with him to try to make the mortgage payment. He was in a bad spot. He called me because I put this magnet on my car and I parked it outside and he saw it. So he said, hey man, I'm in foreclosure. I need to come talk to you about selling my house. So I ran over there and we worked it out. Numbers look like this. He had a $110,000 mortgage. He had a $25,000 mechanics lien from this brand new roof. We had a pretty bad hailstorm in Wiley in 2016, so he never paid them for that. And he had a $1,500 HOA lien because he doesn't like paying the HOA. He was a smoker and smoked in the house. And there was a bunch of, like, when the hail came through, it busted the window, so there was like no flooring, and we had to go in and paint and flooring and clean a lot of stuff up. So the total debt was 166 on this, and I sold it for 265. Buyer's agent commission, I paid 4.5% because I don't care. I wanted as many people to see this as possible. Listing agent commission was 3, so total cost and commissions was 20,000. Total cost to buy and sell was 186,375, and we made about 78, almost 80,000 in gross profit. This sold almost immediately. Full priced offer, asking, sold, done. So 30K rehab out of this. I made over 40K on this deal. This was one of the first deals that I ever did. I learned how to do this before I ever learned to wholesale, before I ever assigned a contract. I was doing stuff like this, stuff like this, stuff like this. This is the stuff that I love. I love this way more than wholesaling. This is more fun for me. So information changes situations. That's a quote from Eric Thomas, E.T. the Hip Hop Preacher. I thank you all for staying and watching. Thank you so much. And that's it. That's my presentation. Thank you guys.
Way to go, Josh. That was awesome. I felt like you were just riffing. I felt like I was on I don't know, some sort of YouTube channel that I didn't know I was subscribed to. And then I got sucked in and I was like, this is amazing.
Sweet. Well, thanks.
Really, really great. I do think that a lot of it was super fast, and
Yep.
I know that people will have questions. And
Absolutely.
so if you could pull.
Uh-oh. Sorry. Hang on. Working on it. Here we go. Yup, da, 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 da. I don't know what happened to my audio, but I can't hear anything that anybody's saying. But I'm imagining that you guys want contact info.
I'm thinking it's Britt.
Okay.
It's my.
I added his number in the messages
It's my
or in the group chat.
Can you guys hear me now?
Yep.
Okay. There's his contact info. This was awesome. We really appreciate it, Josh.
Thank you.
We could have you back on and
Oh yeah.
learn more.
Anytime.
And also, we did record it. We will pull it up,
Sweet.
put it up on the agent portal, and we appreciate it so much. This was amazing.
Thanks for having me, guys. I appreciate it.
You did great.
And thank you, Brittany, for having me. Thank you so much.
Absolutely. You're a rock star. Thanks, Joshua. We appreciate it.
I appreciate it. Thank you, guys.
Bye, guys.
Bye.